Stop everything for a moment because the silver market has just entered a narrow window that historically appears only a handful of times each year, and what happens inside this compressed stretch could dictate the entire path of silver for the rest of 2026. This is not exaggeration, and it is not drama for clicks. It is a direct reading of the data, and the data is flashing signals that demand focus. Today we are positioned inside what cycle analysts define as a volatility expansion zone. When price compresses into this type of structure and time cycles converge, markets do not drift quietly. They make decisions. If you are holding silver, trading silver, or even thinking about entering the market, you need to understand exactly where we stand because the next directional move will not be random. It will emerge from a defined structure that is already in place. Here is what just unfolded. Silver advanced toward 89.67 while gold moved decisively above 5,200 for the first time in weeks. That is not coincidence. Safe haven demand has accelerated as geopolitical tensions surrounding US and Iran nuclear discussions intensify and new tariff policies have injected fresh uncertainty into the global trade system. The dollar has softened. Treasury yields are sending conflicting messages. Beneath that macro noise, the technical structure of silver is tightening into a formation that historically resolves with force. It either breaks higher with momentum that surprises most participants, or it traps early bulls and rotates downward into a deeper consolidation. There is no comfortable middle ground. A decision is approaching, and by the time we finish this analysis, you will know the exact levels that matter, the zones institutions are watching, and what capital is quietly preparing for, while the broader crowd debates whether silver is headed for triple digits or another pullback. Before moving deeper, I want to understand who is listening. Drop a comment and tell me where you are watching from. This is a global market, and the silver story is not confined to one country. Whether you are in North America, Europe, Asia, Australia, Africa, or anywhere else, type your location. I read the comments because it helps me understand the global footprint of this community and how diverse the perspectives are that shape it. Now let us move into the core framework that structures this entire analysis. The model guiding this outlook is called VCPMI, which stands for Volatility Cycle Price Momentum Indicator. It is not a casual chart overlay, it is a statistical framework built to determine where price sits relative to equilibrium. Every market has a mean, a center of gravity where supply and demand are balanced. Price oscillates around that mean. When it extends too far above equilibrium, historical probabilities suggest a reversion lower with 90 to 95% likelihood. When price falls too far below the mean, probabilities favor a reversion upward within that same statistical range. The model defines these extreme zones as sell 1 and sell 2 on the upside, and buy 1 and buy 2 on the downside. If you understand where price is positioned relative to those zones, you immediately know whether you are chasing momentum or entering high probability territory. Right now, silver is trading near 89, and the daily mean sits roughly between 89 and 90. That places us directly at equilibrium on the daily time frame. We are not extended. We are not deeply discounted. We are balanced. And when markets balance at equilibrium inside a volatility window, that is where direction is decided. The weekly sell 1 level sits at 88.03, and the weekly sell 2 level is positioned at 93.09. That 93 level is critical. If silver can close above 93.09 on a sustained basis, resistance converts into support, and the next higher fractal activates. In that scenario, projection targets expand toward 98, then 105, and ultimately 120. Those numbers are not arbitrary. They are derived from geometric expansion analysis that we will explore shortly. But first, you need to understand the alternative path because markets move both directions. The weekly mean rests near 80.22. If silver fails to hold above that equilibrium level, we are not breaking out. We are consolidating. In that consolidation structure, buy 1 appears at 75.16 and buy 2 sits at 67.35. Those zones represent deep accumulation territory where long-term holders and institutional capital typically build positions. No one prefers that outcome emotionally because everyone prefers upward momentum, but preference does not shape markets. Structure does. And the structure at this moment tells us we are at a decision threshold. A confirmed break above 93 opens the door toward 100 and beyond. Failure here rotates price lower into accumulation support. Now consider your own positioning. Are you fully allocated, waiting for a retracement, trading leveraged exposure, accumulating physical metal without regard to short-term price? The reason I ask is because positioning determines reaction. If you are overextended and volatility expands downward, panic becomes likely. If you are underexposed and price explodes upward, fear of missing out becomes the driver. Understanding your own exposure matters just as much as understanding the chart. Time cycles add another layer that most market participants ignore. Markets do not move randomly. They move in repeating rhythms of contraction and expansion. Volatility compresses, energy builds, and then price releases that stored pressure. Today, we are inside a defined volatility expansion window. Historically, these windows complete corrective phases and establish directional momentum. Think of price like a coiled spring that has been tightening. The release phase does not drift, it snaps. If silver maintains position above the daily mean as this window unfolds and then breaks 9309, the expansion likely accelerates upward. However, there is a secondary cycle window that follows shortly after. Historically, that second window either extends the move if the breakout holds or confirms reversal if the initial breakout fails. What you are witnessing is a compressed 2-week structure where the trajectory for months ahead is likely determined. Technical structures never exist in isolation. They interact with macro forces, and today the macro backdrop is charged. Geopolitical tensions remain elevated as negotiations between the United States and Iran hover in uncertainty. The mere possibility of escalation embeds a risk premium into precious metals. Safe haven demand does not evaporate when conflict risk persists, it strengthens. As long as that tension exists, gold and silver retain structural support underneath them. Simultaneously, tariff policies have shifted global trade expectations. A 10% tariff on most imported goods is now active, with suggestions it could rise to 15%. The temporary nature of those tariffs injects uncertainty regarding future policy direction. Businesses struggle to plan in uncertain trade environments. Investors seek assets insulated from political decision-making. Precious metals historically fulfill that role. The dollar adds another dimension. The US dollar index weakened by 0.07% recently, trading near 97.57 and has shown softness over the past month. A weaker dollar enhances the appeal of dollar-denominated commodities for foreign buyers. It requires fewer euros, yen, or yuan to acquire the same ounce of silver. That marginal increase in demand can influence price discovery. When currency dynamics align with geopolitical tension and structural supply constraints, markets pay attention. However, any serious analysis must acknowledge risk. Geopolitical tensions can ease unexpectedly. If negotiations de-escalate and military threats fade, safe haven flows could reverse quickly. Some analysts have cautioned against chasing this rally, arguing that the market may be extended. Additionally, if economic data strengthens and the Federal Reserve signals tighter policy for longer, the dollar could strengthen. A rising dollar pressures commodities broadly, including silver. Demand destruction also emerges at elevated prices. In India, a major precious metals market, domestic silver prices have reached record levels. MCX silver declined 1.31% recently. Jewelry consumption in the third quarter of 2025 fell 16% year over year. High prices reduce affordability. Industrial demand, particularly in price-sensitive sectors, can slow if costs remain elevated. This is the dual reality of silver. It is both a monetary asset and an industrial metal. Safe haven flows can surge while industrial demand simultaneously faces pressure from slower global growth. Tariffs that stimulate defensive investment demand can dampen manufacturing activity. Understanding that paradox prevents emotional overreaction when volatility appears. All of this converges today. Equilibrium on the daily time frame, resistance at 93, support near 80, a volatility window active, geopolitical tension elevated, tariff uncertainty present, dollar softness offering support, demand-sensitive regions showing strain. This is not a casual moment in the silver market. It is a defined inflection point where probability begins to favor decisive movement rather than drift. And in the next segment, we will expand into the geometric framework that projects where that movement could carry price if the breakout confirms or where accumulation deepens if consolidation prevails. Now let us go deeper into the geometric framework, because this is where the structure becomes precise rather than speculative. One of the most overlooked tools in modern technical analysis is the square of 9, a mathematical construct popularized by W.D. Gann. Many traders reference it casually without truly understanding its implications, but when applied correctly, it connects price and time through harmonic relationships. The idea is straightforward, even if the mathematics underneath it are complex. Certain price levels are not random. They are geometrically related to prior pivots, and when price reaches those harmonic levels, reaction tends to occur. That reaction can be resistance, support, acceleration, or reversal, but it is rarely meaningless. In the current silver configuration, square of 9 geometry identifies harmonic resistance clustered near 93 and again near 100. That 93 level is not just important because of the VCPMI sell 2 zone. It is reinforced by geometric angle relationships derived from prior lows and rotational pivots. When independent frameworks converge on the same number, probability increases. Markets respect confluence. If silver pushes through 93 with conviction and closes above it on a sustained basis, resistance transitions into support. That shift activates the next harmonic expansion targets, which align near 98, then 105, and ultimately 120. These are not aspirational projections. They are derived from measurable angular relationships that have historically influenced turning points. On the downside, geometry identifies support harmonics near 85, 81.85, and 79.71. Think of these as a descending ladder of demand zones. If price rotates lower into these areas, historical probability favors accumulation rather than collapse. Institutional capital does not typically buy breakouts at obvious highs. It accumulates into weakness when sentiment turns cautious. If silver were to decline into the 81 to 79 region, that would represent structural reset rather than structural failure. The broader supply deficit narrative would remain intact. The industrial applications would not disappear. The geopolitical risk premium would not instantly dissolve. It would simply offer deeper value entry for patient capital. Here's the key insight that many traders miss. When time harmonics and price harmonics align, volatility expands rapidly. If silver tests 93 while the volatility window is active and time cycles are signaling expansion, the breakout can be violent rather than gradual. Short positions caught above resistance would be forced to cover. Momentum traders would chase confirmation. Liquidity gaps can develop during these acceleration phases, which is why risk management becomes essential. Targets in that expansion scenario remain 98, 105, and potentially 120 if follow-through builds. However, if price fails to sustain above the daily buy 2 level at 85.39, the immediate bullish case pauses. That does not terminate the larger structure, but it extends consolidation. In that scenario, deeper support between 81.85 and 79.71 becomes relevant. Accumulation within those bands historically precedes future rallies, but patience would be required. Markets rarely reward impatience during consolidation phases. Now consider another dimension that receives less attention in mainstream commentary. There is a visible divergence between Western paper pricing and Eastern physical demand. While futures markets in the West can fluctuate sharply, physical silver in certain Asian hubs continues to trade at premiums several dollars above spot. That premium is not theoretical. It represents real buyers willing to pay more than paper price to secure actual metal. When physical premiums remain elevated during paper corrections, it signals tightness in the underlying supply chain. Paper contracts can expand far more rapidly than refined silver can be produced. That creates temporary illusions of supply. But contracts cannot indefinitely substitute for delivery if demand for physical metal intensifies. The silver market has been in structural deficit for 6 consecutive years. Annual global demand exceeds global supply by tens of millions of ounces. Inventories have been drawn down steadily. Unlike gold, a significant portion of silver supply is produced as a byproduct of copper and zinc mining. That means supply cannot simply increase because silver prices rise. Primary silver miners represent a smaller percentage of total output. For supply to expand meaningfully, base metal economics must justify higher production, and that is influenced by broader industrial cycles rather than silver price alone. This structural constraint places a floor under long-term expectations. Demand, meanwhile, continues to evolve. Solar panel manufacturers have worked to reduce silver intensity per panel due to high prices, but overall installations continue expanding globally. Artificial intelligence infrastructure requires silver for cooling systems and advanced electronics. Electric vehicles rely on silver for conductive components and charging systems. High-performance semiconductors depend on silver's superior conductivity. In large-scale industrial projects, the cost of silver is often negligible relative to total project expenditure. When building a massive data center, the price difference of silver becomes marginal compared to the necessity of performance. That reduces price sensitivity in emerging industrial demand segments. At the same time, risks remain. Elevated prices can erode jewelry consumption. In India, one of the world's largest precious metals markets, domestic silver recently declined 1.31% on the MCX exchange even as global prices held firm. Jewelry demand in the third quarter of 2025 fell 16% year over year. That represents demand destruction caused by affordability strain. When prices surge rapidly, discretionary consumption slows. Industrial demand tied to broader economic growth could also soften if tariffs dampen global trade and manufacturing activity. The same trade policies that boost safe haven demand could suppress industrial consumption. This dual dynamic is what makes silver uniquely complex compared to purely monetary metals. The dollar's trajectory remains another variable. Recently, the dollar index weakened approximately 0.07% and has trended lower over the past month. A softer dollar increases purchasing power for foreign buyers acquiring dollar-denominated commodities. However, if economic data strengthens or the Federal Reserve signals prolonged tight policy, the dollar could reverse higher. A strengthening dollar historically pressures commodities. That scenario would not negate structural support, but it could create headwinds during the volatility window. This is why presenting only the bullish argument would be incomplete. Serious investors must articulate both sides. Geopolitical tensions can ease abruptly. A breakthrough in negotiations could remove risk premium quickly. Analysts such as Adam Button have cautioned against chasing extended rallies, suggesting prudence near resistance. That caution is not baseless. Markets often punish late momentum buyers when narrative enthusiasm peaks. So the landscape today is layered. On one side, we have structural supply deficits, expanding technological demand, physical premiums signaling tightness, geopolitical uncertainty, and tariff-driven safe haven flows. On the other side, we have potential de-escalation risk, dollar strength possibility, affordability strain in key consumer markets, and industrial slowdown risk from trade friction. These forces do not cancel each other out. They interact dynamically. What matters now is how price behaves relative to the key inflection levels. Above 93, probability shifts toward upside acceleration with projection targets at 98, 105, and potentially 120. Below 85.39 on a sustained closing basis, consolidation likely deepens toward 81 and possibly 79.71. The weekly mean near 80.22 becomes a critical equilibrium anchor. Holding above it sustains structural balance. Breaking decisively below it would extend correction before renewed accumulation. The next segment will focus on execution and psychology, because understanding levels is only half the equation. The silver market does not just test analytical skill, it tests emotional discipline. And in volatility expansion phases, emotional discipline determines who survives and who exits at the wrong moment. Now we move into the part that most people underestimate, and that is execution and psychology, because knowing the levels does not guarantee success. The silver market is one of the most emotionally demanding markets in the entire commodity complex. It does not trend in smooth lines. It surges and retraces violently. It rallies 10% in days and then gives back 8% just as quickly. That behavior is not a flaw in the market, it is part of its design. If you do not prepare for that volatility mentally before it happens, you will react emotionally when it does. So let us make this practical. Here is exactly what matters over the immediate horizon. First, the 93.09 level. If silver closes above that level on a daily basis and holds it through at least one retest, the breakout is technically confirmed. At that point, the probability expands toward 98, then 105, and potentially 120. The reason the retest matters is because breakouts that hold on retest convert former resistance into support. That shift in behavior signals that sellers at that level have been absorbed. If price simply spikes above 93 and immediately collapses back below it, that is not confirmation. That is a false break designed to trap momentum buyers. Second, the 85.39 level. This is the daily buy 2 threshold. If price closes below that level, the short-term bullish momentum is delayed. That does not mean the larger structure is broken. It means consolidation extends. In that scenario, support between 81.85 and 79.71 becomes the zone to monitor for accumulation. Historically, that type of retracement within a broader structural deficit environment offers opportunity rather than catastrophe. But emotionally, it will not feel like opportunity. It will feel uncomfortable. That is why planning matters before price moves. Third, geopolitical headlines remain critical. Ongoing discussions between the United States and Iran create a live risk premium. If negotiations deteriorate or rhetoric intensifies, safe haven flows can accelerate quickly. If meaningful progress emerges and escalation risk declines, some of that premium can unwind. Precious metals respond rapidly to shifts in perceived stability. The market does not wait for full resolution. It moves on expectation. Fourth, tariff policy. A 10% tariff is active, with the possibility of an increase to 15%. If tariffs rise, uncertainty increases, and capital tends to seek defensive positioning. If tariffs are moderated or rolled back, risk appetite could return to equities and cyclical assets, potentially creating temporary outflows from precious metals. This dynamic does not erase the supply deficit, but it can influence short-term flows. Fifth, the dollar index. Recently, it weakened approximately 0.07% and has trended lower over the past month. If the dollar continues declining and remains below 97, that acts as a tailwind for silver. If it reverses and begins climbing back toward 100, that creates a headwind. Currency dynamics often amplify or dampen commodity moves. Now let us address positioning psychology directly. Imagine silver breaks above 93 and runs quickly to 98. Confidence builds. Comment sections fill with optimism. Then a sudden headline suggests progress in geopolitical negotiations and silver gaps down $5 overnight. What do? If you have not decided your plan before that moment, you will make the decision emotionally while price is moving against you. That is rarely optimal. Markets are designed to provoke emotional reaction. This is why leverage must be approached with caution. Margin magnifies both gains and stress. If you are using leverage and price retraces sharply, margin calls can force liquidation at precisely the wrong time. Physical holders who are not leveraged experience volatility differently. They can tolerate fluctuations without immediate forced action. That difference in structure shapes emotional response. Risk management is not about predicting the future perfectly. It is about surviving incorrect scenarios. Do not allocate your entire net worth into one position. Do not assume price will move in a straight line. Define in advance what you will do if price reaches your upside targets and what you will do if price reaches your downside thresholds. Write it down. Decide before the market tests you. A useful framework is thinking in terms of expected value rather than certainty. Every position carries probability and payoff. The objective is to enter positions where the long-term expected value is positive, even though individual outcomes may vary. If the structural supply deficit persists, if industrial demand continues evolving, if geopolitical uncertainty remains embedded, the long-term bias may favor higher prices. But short-term fluctuations are inevitable. Accepting that reality reduces emotional shock when volatility arrives. Now consider the larger structural backdrop again. 6 consecutive years of supply deficit, tens of millions of ounces of annual shortfall, inventories declining, most silver produced as a byproduct of copper and zinc mining, limiting rapid supply expansion, emerging demand from solar, electric vehicles, artificial intelligence infrastructure, advanced electronics, physical premiums in parts of Asia trading above Western paper prices. These are not fleeting narratives. They represent underlying structural forces. At the same time, jewelry demand in India fell 16% year over year in the third quarter of 2025. MCX silver recently declined 1.31% amid record domestic pricing. High prices can suppress discretionary consumption. Trade tensions can dampen industrial growth. The dollar can strengthen. Geopolitical tensions can ease. None of these risks should be ignored. They are part of the landscape. This is why today represents an inflection point rather than a guarantee. The daily mean near 89 to 90 marks equilibrium. The weekly mean near 80.22 anchors structural balance. Resistance at 93 defines breakout confirmation. Support at 85.39 defines short-term momentum integrity. Deeper accumulation at 81.85 and 79.71 defines structural reset. Above 93, projections extend toward 98, 105, and possibly 120. Below 85.39, patience becomes necessary before momentum reestablishes. The time cycle element adds urgency. We are inside a volatility expansion window. Historically, these windows resolve consolidation and establish directional bias. A secondary window follows shortly after, often confirming or extending the initial move. Big market moves do not announce themselves politely. They emerge from compressed structures when few expect them. Ultimately, success in the silver market is less about being perfectly right and more about staying positioned long enough for probability to unfold. The participants who survive are not those who predict every swing accurately. They are those who manage risk, avoid excessive leverage, and remain disciplined when volatility attempts to shake them out. So here's the reality. Silver stands at a defined decision zone. The macro backdrop is charged. The structural supply story remains intact. Industrial demand continues evolving. Physical premiums signal tightness. Risks exist on both sides. Your responsibility is not to forecast with certainty. Your responsibility is to prepare. Watch 93, watch 85, watch the dollar, watch geopolitical headlines, watch tariff developments, but most importantly, watch your own reactions. The market will test conviction. It will test patience. It will attempt to force emotional decisions. Big moves often follow periods of frustration and boredom. Consolidation feels uneventful until it suddenly is not. Those positioned before the expansion tend to benefit. Those who chase after confirmation often endure volatility without preparation. If silver reaches 100 in the coming phase, know in advance what your plan is. Will you scale out partially? Hold for higher targets? Reallocate? If silver rotates lower into accumulation zones, will you panic or recognize structural reset? Decide now, because the silver market does not reward hesitation. It rewards preparation, discipline, and respect for volatility. And as this window unfolds, those qualities will matter far more than emotion or narrative.